And on to Korea's auto sector as the government there upgraded its GDP forecasts. Joining us now for more is Citigroup's Ethan Kim. He's the #1 ranked analyst on the Bloomberg for Hyundai Mobis, and his recommendations have generated returns of more than 90%. Well, it's good to have you with us, Ethan. Do you still like Hyundai Mobis as much or more so now following the improving economic backdrop over there in South Korea?
First of all, among the Korean auto names, I still prefer Hyundai Mobis because we are seeing a structural improvement in their module business. In the past time, the Hyundai Mobis has been traded at discount to Hyundai Motor because Hyundai Mobis has a highly depend on the sales from the Hyundai Motor Group, including Hyundai Motor and Kia Motor. But we are seeing that now they are expanding their customer base to non-captive automakers, including BMW, Volkswagen, and also they recently announced a contract with the Chrysler to supply a headlamp for their produced vehicles. So we are seeing that now, and also we are seeing that the increasing contribution from the core parts, which bears a high margin, and coupled with the customer base expansion, we think that the increasing contribution from the core parts will trigger further re-rating of the Hyundai Mobis going forward.
Well, Mobis is also needing to address the competition from the likes of Japan's Denso. Mobis has just merged with its affiliate Autonet to expand its electronic sports business. Do you think this is a big help in keeping competition away?
If you look at the recent Denso's profit and loss statements, they are also suffering from the poor profitability along with their parent company Toyota. And also in the European parts makers and also the US parts makers, they are also suffering from the poor profitability. Among the other global parts makers, we think that Mobis is the only one name who are generating the robust profit in this recessionary time. So given the fact that global auto OEMs and also the global parts makers are suffering from poor profitability, we think that it is a kind of once in a lifetime chance for the Mobis to increase their market share in the global auto market. So
there's been some concern about the price that Mobis paid for Autonet. They think it's been too high, Ethan.
Yes, that's true. I remember that maybe the Mobis paid around more than 2 times price to book when they were acquiring the Autonet, and also we are expecting that for the next 2 years, maybe there will be some dilution around more than 10% for Mobis shareholder in 2010 and 2011. But if we move our scope to for the longer term perspective, we think that the synergy from the merger with Autonet will be larger than that of the dilution, because Hyundai Autonet is now producing car electronic parts, and that's going to be a future growth engine for the Mobis. Because also, along with those facts, Hyundai Motor and Kia Motor are starting their new model cycle starting from second half 2009 with the launch of new Tucson and YF Sonata, and we expect that more and more vehicles will be equipped with more car electronic parts and also core parts. So that's going to be a longer-term growth engine for the Hyundai Mobis. So we recommend to buy at this point and hold for the longer-term perspective. And we definitely expect that there will be some kind of further re-rating of the Hyundai Mobis share price going forward.
Well, let's talk about Hyundai Motor for a moment here, because it looks like it's been a mixed picture for that company in June. The high margin domestic sales up to a record 75,000 units. But when you look at overseas sales, they were stagnant year on year, dipping about 1%. Are you still expecting a better outlook in the second half for Hyundai Motor or not?
Okay. Yes, that's true. In second quarter 2009, both Hyundai and Kia recorded the domestic sales volume was a record high, mainly driven by first the government incentive scheme for old clunkers, which is effective from the May 2009, and also there is one also the excise tax cut, which was valid from the December 08 until June 09. So there was kind of high demand for in the domestic market. While the domestic market recorded a very robust sales performance in June month, but as you mentioned, the export shipment volume growth is still stagnated because in the key markets, including Western European market and also U.S. market, the auto demand are still bleak. But in moving into second half 09, we expect that in third quarter 09, the domestic shipment volume may plunge more than 20% in quarter-on-quarter terms. But in fourth quarter, we are seeing that the domestic volume will be recovered somewhat because there is a high good seasonality for the domestic market, and also we are expecting that the export to shipment volume will be recovered to somewhat moving into second half 09, driven by the better shaping macroeconomic conditions.
And when you look at the price-to-book value analysis for Hyundai Motor, you say that is a relevant way of actually rating the company. How come?
Okay, if you look at the profit structure of Korean auto names, they are very vulnerable to the currency rate. So we don't think that any earnings valuation ratio is not appropriate to valuing the Korean automakers. So that's why we are valuing the Hyundai Motor and also Kia Motor by price-to-book valuation approach.
Okay.